Hello, my dear friends, and welcome back to our channel, Mysterious Untold Books. Introduction. In the winter of 2017, Maria watched in amazement as her colleague's small Bitcoin investment transformed into a life-changing sum. It's not just about the money, he explained over coffee. It's about being part of a revolution that's redefining how we think about trust, value, and financial freedom. Maria was intrigued but skeptical. Wasn't this just another bubble? As she began researching, she discovered a world far more nuanced than headlines suggested, a fascinating intersection of cryptography, economics, and social change that was silently reshaping our financial landscape. The journey into crypto assets represents more than just an investment opportunity. It's an exploration of how technology is fundamentally altering our relationship with money. From Bitcoin's emergence during the 2008 financial crisis to the flourishing ecosystem of thousands of digital assets today, this technological revolution challenges our most basic assumptions about currency, value storage, and financial intermediation. By understanding the origins, technology, and the evolving role of crypto assets in our global economy, we gain insight not just into a new asset class, but into the future of finance itself, a future where transparency, accessibility, and individual sovereignty may replace the centralized structures that have dominated for centuries. Chapter 1: Satoshi's Vision, Birth of Bitcoin Amid Financial Crisis. The autumn of 2008 cast a dark shadow over global financial markets. As Lehman Brothers collapsed and financial institutions worldwide teetered on the brink of disaster, trust in the banking system was evaporating. Millions lost homes and savings while governments scrambled to assemble massive bailout packages for institutions deemed too big to fail. Against this backdrop of economic chaos, a mysterious figure known as Satoshi Nakamoto was quietly finalizing something revolutionary. On 31st October 2008, Satoshi released a 9-page white paper titled Bitcoin, a peer-to-peer electronic cash system. The timing was deliberate. The day after publishing, Satoshi sent an email to a cryptography mailing list explaining, "I've been working on a new electronic cash system that's fully peer-to-peer with no trusted third party." When Bitcoin's network went live in January 2009, Satoshi embedded a message in the first block of transactions. The Times' 3rd January 2009 Chancellor on brink of second bailout of banks. This reference to a headline from the Times made it unmistakably clear that Bitcoin was born as a direct response to the financial crisis. The first ever Bitcoin transaction occurred 9 days later between Satoshi and Hal Finney, an early supporter who saw potential in this digital experiment. Finney later wrote, "I'm fascinated by the idea of creating a form of money that's independent of any government or corporation." These early adopters weren't just testing new software. They were participating in a radical reimagining of money itself, one where trust would be placed in cryptographic proof rather than central authorities. For months, Bitcoin operated in obscurity, with only a handful of enthusiasts mining and occasionally trading coins worth fractions of a penny. The first real-world transaction came in May 2010, when programmer Laszlo Hanieks paid 10,000 Bitcoin for 2 pesos, a transaction that valued each Bitcoin at less than a cent. Those same coins would later be worth hundreds of millions of dollars, making those possibly the most expensive pesos in history. As Bitcoin slowly gained traction, Satoshi remained active in its development, answering questions and guiding community until mysteriously disappearing in April 2011. The last known message from Satoshi expressed confidence that Bitcoin was in good hands with a growing community of developers. This disappearance only added to the mystique surrounding Bitcoin creation, but it also underscored a fundamental principle. True decentralization means no single person, not even the creator, should be essential to the system's survival. The birth of Bitcoin represents more than just technological innovation. It marks a philosophical response to institutional failure. When traditional financial systems demonstrated their vulnerability to human error, greed, and corruption, Satoshi offered an alternative built on mathematical certainty rather than human promises. This origin story continues to inspire the crypto asset ecosystem, reminding us that moments of crisis can spark transformative innovation when visionaries dare to reimagine fundamental systems we take for granted. Chapter 2: Understanding Blockchain, the Technology Behind the Revolution. James had worked in banking technology for 15 years when a colleague first mentioned blockchain in 2015. "It's just a database," he scoffed, dismissing it as another overhyped technology. 6 months later, after reading about how blockchain actually works, James couldn't sleep. He realized that what made blockchain revolutionary wasn't just its structure, but its ability to create trust without centralized authority, something that could fundamentally transform its entire industry. At its core, blockchain technology combines three existing concepts in a novel way: distributed ledgers, cryptographic security, and consensus mechanisms. Rather than storing data in a central location controlled by one organization, blockchain distributes identical copies of the ledger across thousands of computers worldwide. Every transaction is grouped into blocks that are cryptographically linked to previous blocks, creating an immutable chain of records. This structure makes tampering nearly impossible, as changing any information would require simultaneously altering thousands of copies, a feat requiring computational power beyond what's practically achievable. The Bitcoin blockchain introduced the first widely successful consensus mechanism, proof of work. Miners, specialized computers on the network, compete to solve complex mathematical puzzles, with the winner earning the right to add the next block of transactions to the chain and receive newly minted Bitcoin as reward. This process serves two crucial functions. It secures the network against attacks and provides a decentralized method for issuing new currency. The difficulty of these puzzles automatically adds to ensure new blocks are added approximately every 10 minutes, creating a predictable issuance schedule that will eventually cap at 21 million bitcoins, a stark contrast to the unlimited printing potential of fiat currencies. Beyond Bitcoin, blockchain technology has evolved into diverse forms. Public blockchains like Ethereum expanded the concept by enabling smart contracts, self-executing agreements with terms written in code. These programmable blockchains function as global computers where applications can run without any central authority able to shut them down. Meanwhile, private or permission blockchains emerge for enterprise use, sacrificing some decentralization for greater efficiency and privacy controls. Each variation represents different trade-offs between decentralization, scalability, and functionality. As James dug deeper into blockchain potential, he discovered applications far beyond cryptocurrency. Supply chains could track products from factory to consumer with unprecedented transparency. Digital identity systems could give individuals control over their personal data. Voting systems could become more secure and verifiable. Financial services could become accessible to billions currently excluded from banking. Property records in developing countries could become immutable and fraud-resistant, protecting vulnerable populations from land theft. What makes blockchain truly revolutionary isn't just its technical architecture, but its ability to restructure trust relationships in society. For centuries, we relied on trusted intermediaries, banks, governments, corporations, to facilitate interactions between strangers. Blockchain technology offers an alternative: trust through transparency, cryptographic verification, and distributed consensus. This shift doesn't just improve existing systems, it enables entirely new organizational structures and economic models that were previously impossible. As we continue exploring this technology's potential, we are not just witnessing a new data structure, we are participating in a fundamental reimagining of how humans coordinate and collaborate in the digital age. Chapter 3: The Crypto Asset Ecosystem Beyond Digital Currency. Elena had always considered herself financially savvy, investing carefully in stocks and bonds for years. When her teenage nephew started talking about DFE and NFTs at a family dinner, she nodded politely while feeling completely lost. Later that evening, curious about this world that seemed to engage her nephew so deeply, she began researching. What she discovered wasn't just a single digital currency, but an entire ecosystem of crypto assets serving diverse functions she'd never imagined possible. The crypto asset universe, Elena learned, extends far beyond Bitcoin. Cryptocurrencies like Bitcoin and Litecoin function primarily as digital money, enabling peer-to-peer value transfer without intermediaries. Crypto commodities like Ethereum provide computational resources, essentially functioning as decentralized world computers where applications can run without any central authority able to shut them down. Crypto tokens represent an even broader category, encompassing everything from governance rights in decentralized organizations to digital collectibles and tokenized real-world assets. Decentralized finance, or DFI, as her nephew called it, particularly fascinated Elena. These applications were recreating traditional financial services without banks or brokers. Lending platforms allowed people to earn interest by providing liquidity or borrow against their crypto assets without credit checks. Decentralized exchanges enabled trading without centralized intermediaries holding customer funds. Insurance protocols protected against smart contract failures. These services operated 24/7 worldwide, requiring nothing more than an internet connection and a digital wallet. No paperwork, no minimum balances, no discrimination based on geography or social status. Non-fungible tokens, NFTs, represented another innovation that initially confused Elena but gradually made sense. Unlike cryptocurrencies where each unit is identical and interchangeable, NFTs are unique digital assets that can represent ownership of anything from digital art to virtual real estate to access rights for exclusive communities. Artists who previously struggled with digital reproduction, devaluing their work, could now create provably scarce digital originals. Gamers could truly own their in-game items, selling or transferring them outside the game's ecosystem. Musicians could establish direct relationships with fans through tokenized album releases that included special access or royalty sharing. Stablecoins emerged as a crucial bridge between the traditional financial system and this new digital economy. These crypto assets maintain stable value by pegging to existing currencies like the US dollar, either through collateralization with other assets or algorithmic supply adjustments. For people in countries with unstable currencies or limited banking access, stablecoins offered a way to protect savings from inflation and participate in the global economy without needing a traditional bank account. What Elena realized through her exploration was that crypto assets weren't just speculative investments but components of an emerging parallel financial system, one built on different principles than the traditional economy. This system valued transparency over privacy, open access over gatekeeping, individual sovereignty over institutional control, and programmability over rigid structures. While still evolving and facing significant challenges, this ecosystem represented a fundamental reimagining of how financial services could function in a digital world. The technology wasn't just creating new assets. It was enabling new economic relationships and possibilities that simply couldn't exist within traditional financial frameworks. Chapter 4. Navigating Market Volatility. Lessons from Early Crashes. Thomas had been cautiously watching Bitcoin for months when he finally decided to invest in early 2013. The price had been steadily climbing, reaching around to $100 per coin. Within weeks, it shot up to over $1,000, and Thomas was elated. His modest investment had quintupled. Then came April 2013's crash. In a matter of days, Bitcoin plummeted to below $100. Thomas panicked and sold everything, nursing his wounds and vowing never to touch cryptocurrencies again. 6 months later, He watched in dismay as Bitcoin surpassed its previous high. This pattern would repeat multiple times throughout Bitcoin's history, teaching painful lessons to those who couldn't stomach the volatility. The Metric-Gox collapse in early 2014 represented another defining moment in cryptocurrency market history. Once handling over 70% of all Bitcoin transactions worldwide, this Tokyo-based exchange suddenly announced that approximately 850,000 Bitcoins, worth around $450 million at the time, had disappeared. The price crashed again, losing more than half its value. Many predicted this would be the end of Bitcoin, with mainstream media publishing numerous Bitcoin obituaries. Yet, remarkably, the ecosystem survived and eventually thrived despite this catastrophic failure of a central institution. The 2017 bull market and subsequent crash demonstrated the pattern on an even larger scale. Bitcoin rose from around $1,000 in January to nearly $20,000 by December, driven by mainstream attention and the explosion of initial coin offerings, ICOs. When the inevitable crash came in 2018, prices fell over 80%, and many projects disappeared entirely. This cycle revealed how speculative X's could build and collapse in the crypto asset markets, but also how genuine innovation continued even during the crypto winter that followed. Companies that had raised funds during the boom used the quieter period to build infrastructure that would support the next wave of adoption. The COVID-19 market crash of March 2020 tested Bitcoin's narrative as a safe haven asset. When global markets panicked, Bitcoin initially crashed alongside traditional assets, falling over 50% in a single day. This correlation during extreme stress surprised many believers who expected Bitcoin to behave more like gold. However, Bitcoin's recovery was swift and powerful, outperforming virtually all traditional assets over the following months. This pattern suggested that while Bitcoin might not be immune to global liquidity crises in the short term, its fundamental value proposition remained intact and potentially strengthened in an environment of unprecedented monetary stimulus. The May 2021 crash, triggered partly by Elon Musk's tweets about Bitcoin's environmental impact and China's mining crackdown, saw Bitcoin fall from $64,000 to below $30,000. This episode highlighted how the market remains susceptible to influential voices and regulatory actions despite its growing maturity. It also demonstrated how narratives around Bitcoin could rapidly shift, with environmental concerns suddenly taking center stage after years of focus on other aspects of the technology. These market cycles reveal profound truths about both crypto asset markets and human psychology. The extreme volatility isn't just a bug but a feature of price discovery for a revolutionary technology with uncertain future value. Each cycle attracts new participants, stress tests the infrastructure, and ultimately strengthens the ecosystem by eliminating weaker projects while highlighting genuine innovation. For investors, the key lesson isn't to avoid volatility but to develop the emotional resilience and long-term perspective necessary to navigate it. Those who understand the fundamental value proposition of crypto assets and can separate signal from noise during market extremes are positioned not just to survive these cycles but to use them as opportunities for strategic accumulation and growth. Chapter 5. Institutional Adoption, Wall Street's Cautious Embrace. When Jamie Dimon, CEO of JP Chase, called Bitcoin a fraud in September 2017, it seemed to confirm Wall Street's dismissive attitude toward cryptocurrencies. Yet behind the scenes, a transformation was already underway. By 2019, JP Morgan had launched its own digital coin for instantaneous payments between institutional clients. This remarkable reversal illustrated the financial industry's evolving relationship with blockchain technology and crypto assets, from outright rejection to cautious exploration and eventually strategic implementation. The entrance of Fidelity Investments into the cryptocurrency space marked a significant milestone. In October 2018, This traditional asset manager with trillions under management announced Fidelity Digital Assets, a separate company providing institutional-grade custody and trading services for crypto assets. Abigail Johnson, Fidelity's CEO, had been personally interested in Bitcoin since 2014, when the company began mining Bitcoin in its research lab. "I am a believer," she told a cryptocurrency conference. "I am one of the few standing before you today from a large financial services company that has not given up on digital currencies." This early conviction positioned Fidelity ahead of competitors when institutional interest eventually accelerated. Paul Tudor Jones, a legendary macro investor, catalyzed institutional adoption in May 2020 when he announced he was allocating a small percentage of his assets to Bitcoin as a hedge against inflation. In a market letter titled "The Great Monetary Inflation," he compared Bitcoin to gold in the 1970s and predicted it would be the winning asset as central banks engaged in unprecedented monetary expansion. His endorsement provided permission for other institutional investors to consider Bitcoin allocation. "Every day that goes by that Bitcoin survives, the trust in it will go up," he explained in his CNBC interview. Coming from a respected traditional investor rather than a cryptocurrency enthusiast, this perspective carried special weight. MicroStrategy's Bitcoin Treasury strategy represented perhaps the boldest institutional move. In August 2020, this business intelligence company announced it had purchased $250 million in Bitcoin as its primary treasury reserve asset. CEO Michael Saylor, previously a Bitcoin skeptic, had undergone a complete philosophical transformation. "This investment reflects our belief that Bitcoin is a dependable store of value and an attractive investment asset with more long-term appreciation potential than holding cash," he explained. The company continued accumulating, eventually holding billions in Bitcoin and inspiring other corporations to consider similar strategies for protecting shareholder value against monetary inflation. BlackRock, the world's largest asset manager with nearly $10 trillion under management, moved gradually from skepticism to engagement. In 2017, CEO Larry Fink called Bitcoin an index of money laundering. By 2021, the company had begun trading Bitcoin futures and added Bitcoin exposure to two of its funds. This evolution reflected growing client demand and recognition that crypto assets were becoming too significant to ignore. When BlackRock Chief Investment Officer of Global Fixed Income stated that crypto is here to stay, it signaled that even the most conservative institutions were reassessing their stance. The institutional adoption of crypto assets represents more than just new investment flows. It marks a legitimization of a technology once dismissed as fringe or fraudulent. Each major institution that enters the space brings not only capital but also regulatory compliance frameworks, risk management expertise, and client education resources. This infrastructure development helps mature the ecosystem, potentially reducing volatility and increasing accessibility for both retail and institutional participants. While early crypto asset advocates may worry about Wall Street co-opting their revolution, this institutional embrace may ultimately be necessary for crypto assets to achieve their full potential in transforming the global financial system. The question is no longer whether traditional finance will engage with crypto assets, but how this integration will reshape both the cryptocurrency ecosystem and the broader financial landscape. Chapter 6. Portfolio Strategy: Balancing Risk and Opportunity. Sarah, a 42-year-old physician with a comfortable income and traditional investment portfolio, had been reading about Bitcoin for years but hesitated to invest. The volatility seemed too extreme, the technology too complex. When a colleague mentioned he had allocated % of his portfolio to crypto assets and had seen remarkable results, Sarah decided to investigate more seriously. What she discovered wasn't just a speculative asset but a potential portfolio diversifier with unique characteristics that could actually reduce overall portfolio risk when properly sized and managed. Modern portfolio theory, developed by Nobel laureate Harry Markowitz, emphasizes that assets should be evaluated not in isolation but by how they affect the risk-return profile of the entire portfolio. Sarah learned that crypto assets like Bitcoin had demonstrated remarkably low correlation with traditional assets such as stocks, bonds, and gold over long periods. This statistical independence meant that even a small allocation to crypto assets could potentially improve a portfolio's risk-adjusted returns. One Yale study suggested that an optimal portfolio might include 1 to 6% allocation to major crypto assets, regardless of an investor's personal opinion about their intrinsic value. The sizing of a crypto asset allocation proved crucial. Sarah discovered that many financial advisors who had embraced crypto assets recommended starting with a small position, perhaps 1 to 2% of a portfolio, and allowing it to grow or shrink with the market rather than trying to time entries and exits. This approach acknowledged both the significant upside potential and the extreme volatility. A small enough position meant that even a complete loss would not seriously damage overall financial health, while still providing meaningful exposure to substantial gains. As one advisor put it, size your position so you can sleep at night during 80% drawdowns. Rebalancing emerged as another key strategy for managing crypto asset volatility. By periodically adjusting positions back to target allocations, investors could systematically sell high and buy low without attempting to predict market movements. For example, if a 2% Bitcoin allocation grew to 5% during a bull market, rebalancing would involve selling some Bitcoin and redistributing to other assets. Conversely, after significant price declines, rebalancing would trigger purchases at lower prices. This disciplined approach helped remove emotion from investment decisions during periods of market extremes. Diversification within the crypto asset portion of a portfolio presented another consideration. While Bitcoin remained the dominant crypto asset by market capitalization and institutional adoption, other assets offered exposure to different use cases and technologies. Ethereum provided access to the growing decentralized finance ecosystem and programmable blockchain applications. Smaller crypto assets offered higher risk but potentially higher rewards as the sector evolved. Sarah learned that many investors allocated a majority of their crypto asset exposure to Bitcoin and Ethereum while maintaining smaller positions in select alternative projects with strong fundamentals. The tax implications of crypto asset investing required careful planning. In many jurisdictions, each transaction, including crypto-to-crypto trades, triggered taxable events. Sarah learned about tax loss harvesting strategies that could offset gains, as well as the benefits of longer holding periods to qualify for lower long-term capital gains rates. She also discovered specialized retirement accounts that allowed tax-advantaged crypto asset investing. These considerations highlighted that successful crypto asset investing wasn't just about market timing, but about thoughtful integration into a comprehensive financial plan. What Sarah ultimately realized was that crypto asset investing didn't require becoming a blockchain expert or trading actively. A disciplined, long-term approach focused on position sizing, periodic rebalancing, and tax efficiency could harness the potential benefits of this emerging asset class while managing its risks. By viewing crypto assets through the lens of portfolio theory rather than speculation, investors could participate in this financial revolution without abandoning the principles of sound investing. The key was not to predict the future of any specific crypto asset, but to build a resilient portfolio prepared for multiple possible futures in a rapidly evolving financial landscape. Chapter 7. Regulatory Evolution: Global Responses to Cryptocurrency. When Marco launched his cryptocurrency exchange in 2013, the regulatory landscape was virtually non-existent. Operating from a small apartment in Singapore, he served customers globally with minimal compliance requirements beyond basic business registration. By 2018, everything had changed. His company now employed a team of compliance officers, required identity verification for all customers, and navigated a complex patchwork of regulations that varied dramatically by country. This transformation reflected the broader evolution of cryptocurrency regulation, from regulatory vacuum to increasingly sophisticated frameworks attempting to balance innovation with consumer protection, financial stability, and security concerns. Japan's response to the metric ton Gox disaster illustrated how crisis could catalyze regulatory innovation. After this Tokyo-based exchange collapsed in 2014, losing hundreds of millions in customer funds, Japanese authorities faced a choice: ban cryptocurrencies entirely or develop a framework to make them safer. They chose the latter, becoming one of the first major economies to recognize Bitcoin as legal property and establish a licensing system for exchanges. This progressive approach transformed Japan into a leading cryptocurrency market and demonstrated how thoughtful regulation could foster innovation while protecting consumers. The Japanese model became influential globally, with other jurisdictions studying its balanced approach to oversight without stifling technological development. Switzerland's Crypto Valley in Zug emerged as another regulatory success story. Rather than creating entirely new regulations for blockchain technology, Swiss authorities clarified how existing laws apply to crypto assets and created the supportive environment for innovation. The Swiss Financial Market Supervisory Authority, FINMA, developed a pragmatic classification system for tokens based on their function rather than their technology. This approach provided regulatory clarity while allowing experimentation. The result was a thriving ecosystem of blockchain companies that contributed significantly to the Swiss economy while maintaining the country's reputation for financial stability and integrity. The United States demonstrated the challenges of regulating crypto assets through existing agencies with overlapping jurisdictions. The Securities and Exchange Commission claimed authority over tokens that functioned as investment contracts. The Commodity Futures Trading Commission regulated Bitcoin as a commodity. The Financial Crimes Enforcement Network focused on anti-money laundering compliance, and the Internal Revenue Service treated crypto assets as property for tax purposes. This fragmented approach created significant compliance challenges for businesses operating across these regulatory boundaries. Companies often found themselves caught between agencies with different interpretations of how existing frameworks should apply to this new technology. China's regulatory approach evolved from early tolerance to increasingly strict control. Initially home to the majority of Bitcoin mining operations and trading volume, China executed a series of increasingly restrictive policies, culminating in a near-total ban on cryptocurrency activities by 2021. The government's concerns range from capital flight and financial stability to energy consumption and monetary sovereignty. Each new restriction triggered market volatility but also accelerated the geographic diversification of mining operations and trading activity, ultimately making the Bitcoin network more resilient against single-country regulatory actions. The European Union pursued regulatory clarity through a comprehensive framework called Markets in Crypto-Assets, MiCA. This approach aimed to harmonize rules across all EU member states, reducing regulatory fragmentation and creating a clear path for compliant innovation. The EU's emphasis on technological neutrality, regulating the economic function rather than the underlying technology, represented a sophisticated approach to balancing innovation with consumer protection. By creating a single set of rules for the entire European market, MiCA aimed to position Europe as a competitive jurisdiction for cryptocurrency businesses while maintaining high standards for investor protection. The regulatory evolution of crypto assets reveals a fundamental tension between their borderless nature and the jurisdiction-bound character of traditional regulation. The most successful approaches have recognized that cryptocurrency represents not just a new asset class but technological paradigm shift requiring fresh regulatory thinking. As this technology continues to mature, we are likely to see further regulatory convergence as jurisdictions learn from each other's successes and failures. The challenge for regulators and industry participants alike is finding the balance that protects consumers and financial stability while allowing this transformative technology to realize its potential for creating more inclusive, efficient, and resilient financial systems. Thank you for listening. Audiobook by Mysterious Untold Books.